Hi, this is James again. Today we're going to take a look at Bank POV. Bank POV, the name tells you exactly what it does. When you're ready to apply for a loan or you're planning ahead to apply for a loan, this tool will help you understand how your business looks to a lender. This will give you the same metrics that lenders use in terms of evaluating the financial condition of your business and whether they can extend credit to you. So it's a great resource for you, again, whether you're ready today or whether you're going to be applying for a loan in the near future and you want to make sure that you're prepared. Bank POV will tell you where you stand on all of the different financial ratios that you will probably encounter regardless of who the lender is. And it's a great planning tool because if you're not all green, as you see here, this example, we will help give you guidance on what you need to do to get to the point where you are all green. You find Bank POV on your tool dashboard. As a reminder, all the tools are in this starting page. Once you log in, this is where you do your work on the dashboard. Also, as a reminder, once you set up your account and linked your data, all these tools are ready to go. All you need to do is click on them to get your analysis. So Bank POV is lower down on the dashboard. You'll find it in the lower left. And all you have to do is click and get your report. Again, if you've used the other tools, you know that we like to put some of the most important numbers right across the top for you. So here with Bank POV, you see the business's equity or its net worth. You also see its net income and its operating cash. And these are here year-over-year comparisons. So we're showing a 2019 and 2020 comparison. So in the example of this test business, you see that net worth grew between the 2 years. And then the net income actually decreased a little bit. And the operating cash showed some changes as well. So this information is going to be helpful to understand the bottom line numbers of what's going on with your business. There are 2 tabs with Bank POV. The first one is called Financial Condition, which shows you the 6 metrics that lenders use to evaluate the financial condition of a loan applicant. And then the second one is called Loan Amount, and that will show you the amount of debt that your business can carry. And we'll show you what that looks like in a moment. But first, let's start with financial condition. Here you see the central graphic, which gives you all the information you need to know to understand how your business looks to a lender. This is an interactive graphic. You'll be able to hover. And when you hover, you're going to get information on each of these 6 key metrics. Before we dive into them, just take a quick look here. There are 6 different metrics, and your business will be rated red, yellow, green on each of these 6 different metrics. And from there, we will provide a summary judgment on that bottom line. If you walked into the bank today, would you get that loan from them? So you can start either with the central graphic or you can look to the right and find out what the analysis is. So right here, this example, this is a risky candidate, which means that using the sample company here, and this is what we've shown in the other examples of a company that has had some ups and downs because of COVID, that right now they have a lot of weaknesses that makes it difficult for them to get a loan. And so we are explaining this situation in the example case. As a reminder, all of the tools are running live with your data once you've connected the data. So every time you run a tool, you're going to get the outcome that reflects your business. What you're seeing here on the tutorials is just a sample company, and you're not going to see any of this output when you run your tool. So you are going to turn on Bank POV, and you're going to get an output that is tailored to your business. I recommend, instead of looking at the summary judgment, starting with each of these 6 metrics. So now let's take a look at what each of them are. First one is the current ratio. If you hover, you'll get an explanation. In this case, the metric was green. So current ratio is really a measure used by lenders to understand, do you have enough cash to meet your expenses? Here, in this case, the company is capable of paying its short-term liabilities. And there's this margin for error in case things get tighter, like expenses go up or your revenues slow down a little bit. For each of these 6 metrics, regardless of what color you are, you're going to get that type of an explanation. You're also going to get action steps. So here, business passed the benchmark, they are green, but still there's always room for growth. So here we say that the lender's going to say the higher your current ratio, the better. So strength in this metric means you're going to be able to meet payments on new loans. So that's why it's important. So even if you are green, in some cases you can continue to improve. The next one we're going to look at is solvency. So solvency is about the total amount of that the business has compared to what it owns. So it's that difference between what it owns and what it owes. When you're trying to apply for a loan, you're going to be increasing the amount that you owe, in addition to increasing your total assets, so that it will affect your solvency ratio. And so here, this example, the business is red, and it's showing that there's too much debt compared to the net worth, and that increases the risk of any loan. The action step would be to really think about what your financial situation is. And here we're calling for, the need for some long-term planning, not only about deleveraging, which means cutting back on your debt, but also looking at ways to improve your efficiencies and your profitability, and that's going to help as well. In this situation, if you have a red flag, it is a strong indicator. So we're trying to give guidance that says you really need to take the time to look at this deeply. Let's talk about the next 3 metrics altogether, because they are individual metrics that are related, and they're looked at a little bit differently from the current ratio and the solvency metric. With current ratio and solvency, the lender wants to know what your number is today, or the day that you apply. They do want to look at your historic numbers and your trends, but most important to them is where you are today. With these other 3 metrics that I'm going to discuss, it's more important about the overall trends. This is why a lender likes to see an applicant who has several years of operating history. A lot of times they want a loan applicant who has at least 3 years of operating history, so they can look at all of these trends over time. And that's why I'm talking about all 3 things here. So the third metric is turnover. And turnover is basically sales or revenues. And here the metric is based on a positive growth trend over time in sales. And then profitability, likewise, is a trend line showing increased profits over time. So not just sales now, we're talking about profits. And then that number, that profit margin, also this is something where the lender wants to see stability or growth over time. And so what happened in the case of this business, because of COVID, there was a period of declining sales, and that meant that they did not have a consistent pattern of growth. The numbers weren't all bad, but they're yellow instead of all green. Again, each of these metrics, you hover and you will get a definition of what happened in the context of your business, and then action steps. So these 3 often work together. And then the 6th metric is the net worth. How much is your company worth? Again, at the top of the tool, you saw the net worth as one of the output numbers because it is so critical, of course. And here, this example, this business, their net worth has grown over a period of time. We give some guidance for someone who is in that positive situation, where one of the ways you grow is by being very strategic and very smart about how you reinvest funds back into your business. And those are some of the things that a lender likes to see, and some of the things that your accountant or your coach or a TA provider can also give you guidance on. So those are the 6 summary outputs, and here's how they look for this one company as a result of the problems with the solvency and the weaknesses in the overall patterns, again, due to COVID in this case. This particular candidate is what we say is risky. So they have challenges, but these are all challenges that can be overcome. One of the things that I really want to encourage people is to use Bank POV as early as possible before you apply for a loan, because you're going to be able to see areas where you have challenges and get thinking about what you can do to improve these challenges. So if you are seeing weaknesses, example, in the profit margin, how do you turn that around? How do you increase your efficiency? If you're seeing declines in sales or the turnover, how do you turn that around? How do you grow? So that when you are ready to apply for that loan, you're in a much stronger position. So this is a great tool for you to use as you plan and as you come back to it. Again, what you're going to see in Bank POV is your current condition. As things change over time, whether it's 3 months or 6 months or what have you, you're going to see different numbers. So keep that in mind as well. I want to remind you about a cool little feature we have here to help you when you are Bank POV as a planning tool. And this is the notes in the upper right corner. You find it right here. All you need to do is click on it and it gives you your little notepad. I'm going to scroll up a little bit to the top. The notepad feature, remember, you can organize your notes based on each individual tool, which is very helpful when you want to find that note again. So here you go down to Bank POV and you click on that. And now you can write yourself a little bit of a note. So what you can say is that solvency is low. I need to look at reducing some liabilities. You could even put a date on this if you want. And now you see it's right here for you. You can edit it later. If you're done with it, you can delete it. So every time you want to use the tool and track where you are, you can do it right here in this feature. If you're done with the notepad, you can just click again. All right, now it's gone. Let's look at the second tab now for Bank POV, the loan amount. Again, this is based on the information provided by your company and where it is now. What you see are 3 different ways of looking at the maximum amount of money you could afford. So this is great for, again, having that conversation with the bank. Unfortunately, a lot of times a business owner has a number in his or her head about the number they need, and then they go and apply to the bank. And once the bank looks at their situation, they say that's not the number that you can afford, and they come up with a different number. You don't want to be in that situation. You don't want to be surprised with what really is the amount of debt that you should be applying for. So this is a very critical tool. There are 2 ways of looking at the debt. The first way to look at the debt is based on the balance sheet. This is tied to that solvency metric. So the first thing you do is look at, on the far left, the capacity for new debt. Here, we will tell you the exact amount, and this is based on your balance sheet, how much new debt you can take on without the lender feeling that you have too much debt. So this is the room to grow on your balance sheet for new debt. And this is what this first column is. You see on the right the explanation for this capacity for new debt. So you see it right here. And this explains exactly what this number means. The second is the debt service. In other words, the monthly payments on the debt and whether you can afford to make these payments or not. So I just said that is the second way of looking at a loan, but there are 3 columns here. So what's going on here? The way to think about these 2 columns is they're showing that same issue of your ability to service debt, but it's giving you 2 different examples. It's giving you a short-term loan and a long-term loan. And here, this helps you understand kind of the critical differences between the 2. For lenders and for accountants and for business owners, there's the concept that a short-term loan is a loan that lives for a period of 1 year or less. So very often it could be something like trade credit, which might be a 30-day extension of credit, basically, which you then use multiple times throughout the year. That would be a short-term loan. Any loan that is a year or less is going to be a short-term loan, which means you're paying off the entire loan, both the principal and interest, in 1 year. So that's where we derive this short-term loan number. When you hover, you'll get the number that, again, fits your current financial condition. And we have explanation of what this means, again, on the text on the right. What we do on this final column is give you an example of a loan that would be a 5-year loan, which means that it's a longer loan. You are going to be paying more interest over time. You're now paying interest over 5 years as opposed to 1 year. So that means it is going to be a larger loan altogether. In addition, there's also the principal on that loan. And you have the advantage of spreading payments over 5 years, so you don't have to pay the entire loan principal in 1 year. As a result, this means this loan is going to be a larger loan. And so what you're seeing is the total amount of new credit on this table. So we're showing you a larger loan that you could afford over 5 years. If it was a 10-year repayment period or a 15-year repayment period, it would be a longer number. But right now, we think 5 is a good benchmark to help you think about where your business stands. A longer-term loan is going to very often be for something like equipment. It may be for property purchase. It is very likely to be for equipment. Also, though, working capital loans and loans for operating funds, again, there are loans that will have a 5-year repayment period. There'll be a fixed loan instead of a revolving loan for 5 years. So that's a very common loan that small businesses see. So that's part of the reason why we're showing you a 5-year period on the loan. And again, there's more than one way to look at the total amount of debt for your business. One thing to note here is this is the total amount. This doesn't mean this is the right amount. So depending on what you're using the money for, if you need money for working capital and you are, again, looking at trade credit or buying inventory, maybe you don't need to take out the full amount that you can carry. You need a smaller amount of loan. What this is showing you is the maximum amount. And in your conversation with your lender and with your advisor, you're going to come up with what's the right amount for you. And these 2 tabs give you everything you need to know when you're having those conversations with your lenders about what's right for your business and helping you understand how they look at your business. And now you have a common understanding of what's going on with your business. That's Bank POV.